How do you know if your trade has discernible edge for a day trade or a swing trade? Let's find out in this video. First, what is edge? I would classify edge as having a good direction and a probability for a trade. The way I personally use discernible edge for me to determine if I'm going to trade that day are two aspects. For a day trade and a swing trade, I'll be covering both of those in this video. For a swing trade, I need the stock or asset class to close above a resistance or below support. That's my edge for a swing trade. And for a day trade, I need it to open below the low of the prior day or open above the high of the prior day. Let's give some examples right now. I'm going to pop over to the SPY and do some quick analysis and some quick explanation. This overall move certainly had, in my personal opinion, really nice discernible edge starting here on the 10th of November. That is because this was a beautiful bullish gap and go. And this gap and go trapped many bear traders. You can see that bear trader there and the good close above this resistance and the good close above this resistance. So we can clearly see a resistance that we did close above on this day on November 10th. And we also closed above the 100 simple moving average on the daily chart as well. An additional resistance, giving a swing trade discernible edge. Now, granted, of course, I did have bear positions that I did lose on and had to exit on the 10th of November, but I was able to get back into some bullish swing trades and day trades because of the gap that occurred on November 17th. So you had 3 bear candles in a row, gapping down into a support. That support was the old resistance from the prior move, which is this candle and this candle, and the old resistance of the 100 simple moving average. In addition, you had the 3 bear candles that were gapping down, creating a bearish retest gap. Therefore, those bear traders were profitable and they were closing their profits by buying to cover. And they just so happened to be buying to cover off of old resistance, new support, 100 simple moving average, giving you and me an opportunity to play this bullish. Regarding what happened recently, you had a very, very nice close on the SPY just 2 days ago. Now, this isn't where you get in immediately with that close. Once the close happens, that is where you can determine, identify, and go through your charts to go, yep, this could potentially have really good edge. With the close above that resistance, which again also happens to be a gap from back over here. This is the gap action that occurred back in September. Closing above this candle and closing above the 200 simple gives you that overall trend direction saying, hey, I'm at least more bullish than bearish. Well, what you'll notice here is this purple line is very, very close to the 200 simple moving average on the daily chart. What most day traders do incorrectly is they just trade no matter what, and they never consider the daily chart. They don't think it's very important. Day traders, the daily chart is your main ingredient. This is what's going to help you identify, should you take a trade at all? Fun fact, there are many days of the month where I actually will not take a trade. They're called Saturdays and Sundays. Kidding. If a stock does not have a good gap or a good range, case in point, Tuesday, November 29th, and actually at open, the 30th of November, I will not take a trade, at least early in the morning. When we gap down on the SPY, let's open up a 3-minute chart and just look at the pattern that we got around the 200 simple moving average on the daily and that old resistance pivot. First and foremost, an obvious double bottom pre-market with an absolutely classic neckline close with volume. Again, that close above resistance, edge. This is now, for me, somewhere that I'm looking to play bullish. And it just so happens that the purple line and that 200 simple acting as old resistance, new support on a daily chart is going to help us intraday. So I am looking for my bullish entry based on the close above resistance, based on the double bottom, based on the volume, and the fact that you have bear candle closing above the 10 EMA, which this just so happens to be my favorite candle. This is your high wave indecision candle. So your entry on SPY would have been above that candle with a stop somewhere down there. And that would have been your bullish day trade based on edge from the daily chart, which is the gap below the low of the prior day. Most day traders are just always taking trades no matter what, without any recognition of should they be taking a trade and why they should be taking a trade. You need to have a systematic methodology for what you look at, what you determine, and create consistency in your routine. When you have a normal job, you have your hours and your days that you work. For me, I would give you an amazing suggestion to have 2 to 3 hours, a certain amount of days per week that you will trade, that you've carved out to trade if certain parameters are hit. Case in point, let's pop over to Tesla. And what I'm going to do is look at the daily chart on Tesla and just show you all the times that I did not take a trade based on the gap. They're here outlined in red. Now, on these red lines, I do not take a trade early in the morning because the gap is not above the prior high or below the prior low. So that means that approximately 8 a.m. Central to 8:30 a.m. Central, I can easily, clearly, and simply determine, am I going to be in front of the computer for the next 2 to 3 hours? And usually, mostly, the answer is no. I'm not going to be in front of the computer for that period of time. I'm going to walk away, do the dishes, do my jump rope, hang out with little man, hang out with my wife, read a book, do something engaging, something powerful, make money doing something else with my life, whatever it might be. And then I have the ability to come back between 11 and 2 Central, those 3 hours, midday, to see if there's another trade setup that might be brewing or happening. That exact time frame and schedule will work wonders for you if you follow it. Example today, Tesla did in fact open below the low of yesterday. And since it did that, I now have the ability to trade it early in the morning. I can sit here, my morning's already carved out, so that means my afternoon is going to be to help and serve and enrich lives with you. Meaning I've already taken trades, I've already set it up, and now I have all the other day to do whatever I want because I have followed that schedule, that systematic routine, developed that edge for my trading. We're going to look at one other stock after this, which is Salesforce. So stay tuned for that. Here is the open on Tesla, the first 3 minutes. And again, we did open nicely. This particular wave count for me, I was viewing it and analyzing it pretty early in the morning as this was the wave 3. So we had a 1, 2, 3, 4, 5. Now, regardless of what my analysis was at that stage, I can tell you when this candle came in here, we set up a 10 EMA entry above here with a stop below there. I didn't love the risk reward, and I'm kind of glad that it didn't trigger because it probably wouldn't have worked. So entry there, stop there. That was my actual setup, and it just simply did not trigger, which is a good thing. So once it started breaking down, I canceled the order. No loss. All is good, but I'm watching it. Why am I watching it? I'm watching it because it has edge. It had that gap on the daily chart that allowed me to take it early in the morning. Keep that in mind. So now, again, per my rules, I'm just waiting for a 10 EMA. Here's your first bull candle to close below the 10. So I set the short up. Short here, stop loss right there. This also doesn't end up triggering. And boom, we have a strong bullish move, which is the wave 5 new high completion. 1, 2, 3, 4, 5, 6, 7 bull candles in a row. Big bull volume on the 7th candle. A decade ago, this is where I buy all of the shares. But now, with more training and a lot more experience, I'm able to tell you that this is not the time to buy. What we want to do is now begin creating our risk-reward profiles, knowing that a previous resistance yesterday and the pre-market high is around 196.50. We have a wave 5. We have new increased volume. It's a good opportunity to look for a long or a short if the long consolidates. Here's your bear candle closing above the 10. This is when I said, okay, I need it to trade sideways for 30 minutes. And if it does that, and if it breaks higher, then I will take the trade. Just simply did not happen. Next few candles come in, blah, 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 blah. And here is your bull candle that closes below the 10. Short here, stop loss there. And that trade ended up playing out eventually for a decent win. It wasn't anything megalithlically fantastic, but it was a small win overall. Now, most traders are going to get stopped out and trailed out right there, but no No, 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 no. Stop move goes negative 0.7, negative 0.5. Once this stop wick comes in, I do lower my stop to that price after that bear candle came in. Got lucky, never got stopped out, and eventually exited right around here for about 0.8 Rs on Tesla right there. So new low, 3 bear candles in a row. I'm profitable for the day on Tesla. Great trade. Now, there was a few traders who also played this breakdown of this pattern here. So if we're going to walk back for just a second, let's go over here and look at the sentiment that occurs at this location. Huge bull candle, very nice bull candle. Both of these candles having the exact same low within the penny. So shorting here with a stop loss here absolutely allows you to trap this bull, to trap this bull, and more than likely be able to lower your stop from where it is to there, and to lose a little bit smaller. The only reason that a lot of traders might not have taken that trade is because this particular candle did not close below the 10. If you're watching and trading a very strict 10 EMA plan, then that might not have allowed you to do that. But either way, the sentiment was still there. The sentiment of, can I lose small? And am I getting in below trapped buyers? But more importantly than all of that, you have discernible edge on the trade because it did gap below the prior low. So you have stops move, you have triggers that are being hit, you have alerts that are going off, and people are actively trading this throughout the day. So last but not least is Salesforce. The reason I'm pulling up Salesforce is because it had a very good gap yesterday, which again gave it discernible edge. And this edge was both bearish and potentially bullish, and I'll share with you why. The earnings report was actually pretty good. They made decent numbers, and I think that the CEO stepping down, Mark, was one of the bigger reasons why it did sell off kind of feverishly. And you had really, really good opportunity to make money on the sell-off intraday. So this is Salesforce yesterday. Here it is. And here is a really good, if you understand gaps and you know how to actively trade, this is a very, very, very clean, super easy to trade short. What I was looking for not only was the short, but was a potential long later, and I'll show you why. On the monthly chart, which is part of my process every single day, looking at a stock, once I've analyzed it, I know where it's at. If I haven't traded in a while, this is part of the process. Looking at monthly charts, monthly moving averages, seeing where they're at to identify if they're offering any level of support. Well, the big blue line, I'm sure you've all bought my kids' book. I literally teach kids how to buy off of the big blue line on stocks they know, like, use, understand. And here it is, 100 simple moving average on a monthly chart on Salesforce. That is going to provide some level of support. So not only the short, but also looking at a potential long was a discernible edge from the daily chart. That's one of the ingredients that I used. And here's the setup that I posted in our official day trade Slack channel for all the traders who have access to the All Access Pass. Everyone has access to this, and we all won nicely on it. But this was what the trade looked like at the time. Was playing this bear candle that was an inside hammer candle. First bear candle that closed with a 10 EMA was taking that trade long on a retest. Stop was the low of the day, giving this one plenty of breathing room to make its interactions and its bounces both up and down. And what you'll notice is that's exactly what occurred. Here is the actual fill on the trade. This candle represents the first time I moved the stop loss. Stop loss was here, increased it to here, then here, then here. Once this bull candle came in right there at 12:21 Central, I moved the stop to here, which was below this candle, only losing at that point 0.41 Rs, which was fantastic. When that bull candle came in right here, I was able to take the stop loss and put it here, which was a 0.19 risk, and exited at my target here on Salesforce. Again, using that edge. My dear friends, the most important part of trading is when you should not trade, because if you do not trade, you definitely do not lose. And trading is about protecting risk capital as much as humanly possible. I want you to be aggressive. I want you to win, and I want you to know exactly what to look for when you are taking your trades. How to go, I'm not trading today, or I'm not trading yet. I'm going to wait. I'm going to be patient. These are the hours that I'm going to trade, just like at your job. If you have any questions about any other stock, gap, performance, or anything I can help you with, post them in the comment section below. My mission is to enrich lives, and I happen to be the best in the world at that. I would love to assist you. Thank you so much for watching this video. You rock.